Now from finance, we are moving to food and FMCG. Patanjali Foods is the next stock on our radar. Now, it was a pretty steady quarter for Patanjali Foods as well. The profit was boosted by a 141 crore rupee tax credit. And then the weakness in edible oil margins was offset by strength in FMCG. We have with us Mr. Asthana, CEO at Patanjali Foods, joining in. Mr. Asthana, thanks very much. Good to have you in. So I'm just breaking down the numbers for our viewers. Overall, your revenue is up 21%. Your margin is pretty steady at around 5.6%. But if I break down the segments, then there is margin improvement in FMCG. I think your margin's gone from 10% to 12% over there. But there's some pressure in margins on the edible oils business. So let's take it step by step. Just walk us through what's happening, first of all, with the whole GST transition. Is all that behind us? Did that have any bearing on your, either arms of your business in Q2? And then how are you looking at growth in the second half now? First, at the headline level.
So headline level, just a quick one on the numbers first. So on edible oils, actually, we have improved from quarter one. This quarter, we did nearly 3.53% of margin, EBITDA basis, which is pretty much in the ballpark range of 2 to 4% that we typically do. FMCG, we have consistently maintained that we will be upwards of 10%. We have consolidated the numbers between the HPC and the food, so it's about 12.23%. And on a net basis, also, we are pretty much about 6% plus on the EBITDA margin basis. So broadly, the numbers are pretty positive. We are very confident. Coming to the GST part of it, yes, the impact is there. We can witness it. But as I've consistently maintained, that these are food sort of products with the price points and at the level at which it is. The instant uptick is very difficult to get immediately. It will take a couple of quarters. But our estimation is that on an overall basis, by the end of this year, we should see 300 to 400 basis points of uptake on the sales part of it. So the revenue should definitely get the GST boost of that over and above the volume growth that we're targeting in foods and HPC. So that should be pretty much there.
Okay, so you're saying 300 basis points uptick at a revenue level, that would be on the FMCG side, right? So there'll be a 300 basis points GST boost when we look at the full year pictures. Just going back to margins, as you explained, now that you've consolidated home and personal care and with the FMCG, so this 12%, is that a steady state expectation that one can have? That 12% is going to be the new normal for your FMCG business?
We should get actually better than that because this quarter, some of the overhang of the foods continued. And so those corrections are getting taken. So I think pretty much in the ballpark range of 12 to 14% is what we're targeting. And it won't happen immediately because there is still some bit of overhang that we're witnessing post the festive season. So typically things tend to go down a bit, immediately in November and part of December. But broadly, that is the target, that between 12 and 14% on the HPC will maintain, between 2 and 4% on the veg oil side. But pretty much at the higher end of the band, if we can do that, then that will be very positive for the company.
Just to reconfirm, sir, what is the likely edible oil margins in the second half of the year? Missed that number?
So we are targeting pretty much close to 4% is what the upside target is. The markets are looking positive. That's very supportive to the overall price points. And we are reasonably confident of pretty much remaining at currently at 3.53%. The second half tends to be nearly 2/3 of the sale. So I'm quite hopeful that we should be pretty much closing closer to 4%, if not exactly 4%.
Okay, all right. And what about FMCG? By when does it become 50% of your mix? You've been guiding for that. You've been making strides in that direction. But by when does it take place?
We are making, Nigel. For example, this HPC business post the consolidation, there was a spike in the veg oil prices because of which the percentage-wise, it is still close to 70-30. But my hope is that in 3 years' time, at a target basis, that we should be pretty much close to 50-50, both for FMCG and edible oils.
And individually, for the home and personal care business, I don't know if it makes sense now to look at individual margins because you're talking consolidated as FMCG as a whole. But at an individual level, what are the margins of that business? I mean, what do you expect for the second half?
So the margins have been very positive on the HPC side. I think owing to some of the price point changes that we did and some of the gains that we got on account of the purchase efficiencies. So it has been 22% plus on the home and personal care front.
And that is to be sustained?
We would like to sustain it. I mean, margins typically the ballpark range has been close to 18%. So this is more one-off benefit that we typically got, post the acquisition in last quarter. So I don't believe it will be as much as that. But between 18 and 20%, we are pretty confident of maintaining.
So just okay. So just to revisit, like you told us on the edible oil business, you're looking at targeting 4% margin, and FMCG, the blended FMCG with HPC. What would perhaps the exit margins be, likely exit margins for the FMCG business for this year?
So this consolidation process is still on. We'd like, so currently what you're seeing 12.2%. This we'd like inching closer to 13% plus. And because we have only half a year, for the numbers. And next year, we certainly want to cross 14% on the FMCG overall on a consolidated basis. And 4% we are targeting for the veg oils.
Okay, all right, Mr. Asthana, we appreciate you joining in. Wishing you all the best. You're sounding optimistic about the second half of the year. We'll hold you to some of these numbers. Wish you a good day ahead, and we catch up soon.
Thank you.